Hey everyone, me Kevin here. This morning was an absolute and complete disaster, and we've got potentially more disasters coming up, including the fact that 71% of the S&P 500 by market cap reports by July 29th. That is the 29th of this month, which means we got a whole lot of earnings coming up, and we're probably going to get a whole lot more bad news, because the news we got this morning is probably going to lead the Fed to flip-flop, and I hate to say it, this, in terms of earnings season, might not help the case. The Nasdaq, on the other hand, has seen now 50% of its stocks being down 50% or more from their 12-month highs. Some non-profitable tech, biotech, and payment services are down all the way up to 80%. And the MSCI Technology Index for the world has tech down 30%. Clearly, investors are finally diversifying their portfolios out of tech and out of high growth, and it's leading to pain in the markets. But are they right to do so when we have CPI numbers like the ones that came out this morning? Let's talk about what happened this morning and how this could completely reset what the Federal Reserve has for us in store, and boy, oh boy. But first, before we talk about what the Federal Reserve has in store, we've got to, of course, talk about this chart right here, which has to do with the R word. Folks, the R word is recession. And we've actually got to start using the word rather than calling it recession's R word. Just say recession. We're probably in a recession. Don't wait until it's too late to realize we're in a recession, because guess what? Most of the pain tends to be over before we're actually technically in a recession. And that's because not only do you need to have 2 quarters in a row of negative GDP, but you've actually got to have these economic boards, the National Bureau of Economic blah, 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 determine, okay, we're actually in a recession, and it's all in hindsight. It's a complete disaster. The reality is, markets realize, and this is why everyone's talking about it. Here's a chart of the number of the word recession, or number of times the word recession is used in news articles, and you can see it's absolutely skyrocketed. And there's no freaking surprise, because inflation is going nutso. So nutso, in fact, that we can't even report right. Take a look at this chart here. This chart here shows you U.S. inflation coming in hotter than forecast, the hottest inflation now in the last 40 years. This shows you inflation going all the way back to 2005 over here. You can see we have the biggest month-over-month gain in inflation since 2005, the highest headline inflation read in more than 40 years, folks. This is intense. Inflation came in so nasty this morning, and at the same time, Pepsi told us they still have pricing power, and Frito-Lay and Mountain Dew indicated that they have pricing power, passing on about a 12% higher pricing in the second quarter, that the Bank of Canada's central bank said, you know what, we are actually now starting to face the danger of the spiral. That is the wage hike and then the price spiral. Wages go up. When wages go up, people end up being able to spend more money, providing purchasing power to Pepsi, Frito-Lay, and Mountain Dew. And then guess what happens? They raise their prices, and then prices go up. And when prices go up, then all of a sudden wages also have to go up, because people can't afford the cost of living anymore. So what did the Bank of Canada do today? Well, the Bank of Canada decided, you know what? Hey, look, we know that the market is pricing in a 75 basis point hike, but yeah, we're going to can that. We're actually just going to put on some pants, and we're going to raise rates by 100 basis points, which translates to a full 1 percentage point hike. Something that maybe Jerome Powell should actually take a little bit of a hint from. In fact, we can even show a chart now here that shows us what parts of the world have actually finally instituted a 100 basis point hike. You could see those pictured here in pink of countries that have finally given us a 100 basis point hike. And you know which one's oddly missing over here? It's right here, the United States. Put those pants on. Yeah, it's time to raise rates appropriately. And so we got to talk about what this means for the Federal Reserve, because the reality is pretty much Wall Street was expecting inflation to come in between 8.8 to 8.9%, and they were expecting that month over month. So this was the year over year. They were expecting that month over month we were going to be sitting at 0.5%, which would be an annualized rate of about 6%, right? We were expecting core to also come in about 0.5%, again annualized at about 6%. But unfortunately, we didn't get anything close to that. We got 9.1% on headline, which is crazy. We got the highest month over month read since 2005 at 1.3%, and we got core coming in at 0.7%, which translates to 8.4%. And this is going to change things for the Federal Reserve, especially because we didn't just see what Joe Biden told us, which was, oh, well, this last CPI report doesn't reflect that gas prices came down 40 cents. No, Biden, it has not only to do with gas prices. In fact, it has to do with a whole heck of a lot of things. Laundry and dry cleaning services up 0.8%. And 10.2% on the year. Education services up 1.7% on the year. Airlines down 0.2% on the month-over-month basis, which is good, but still up 34.1% on the year. Car and truck rentals, just in the month, 3.7%. That's crazy. Home insurance up 2.1%. Folks, that's over a 24% annual hike for homeowners insurance. Dental services up 2%. Hair and shaving products up 1.2% on the month. Computers and peripherals, we thought these were going to get cheaper. No, what are they? They're up 1.3%. That's over 13% annualized inflation. Audio equipment up 3.2%. Used cars and trucks, Kathy Wood said these were going to go down, up 2.2% on the month. Rent, folks, went up 0.7% for rent of primary residence, and even ice cream was up 3.1% on the month-over-month basis. Totally insane. The only thing that was down that actually seemed to be of interest was the fact that prices for shirts, men's apparel, were down 3%. That's it, because even paper towels went up 2.2% on the month. Absolutely insane. So now we've got to understand, what does this mean for the Federal Reserve? Well, the Federal Reserve is going to have a very, very, very important response to this. And so what do we have now? Well, the Fed letting us know that there's a 50% off coupon code down below that now also, starting later today, is going to come with free trade ideas included for those of you in the Stocks and Psychology of Money group. Not just trades I make, but also trade ideas. This is a new feature that we're releasing. Lowe's partnership, archives of all of our live streams, daily live streams when the market is open. We've got fundamental analysis in these and in other lectures. Again, that Lowe's partnership saves you a lot of money, especially in the real estate groups. Boy, there are going to be opportunities for real estate coming up. And we do fundamental analysis on real estate as well, so you get to see some deal analysis, recorded lectures, and I'm constantly adding new ones, so that way you're not getting a stale course. You're getting a course that's living and breathing with markets, and as we get more information, we provide more information in the courses. So absolutely, check that out, link down below, before prices for the programs go up shortly. So what are markets pricing in now, and what is the Fed likely to do to us, and what is something that we haven't actually talked about regarding the Fed yet? Well, first, right now we've got markets pricing in a 100 basis point hike in July with a 33% chance of probability and a 33% chance of a 75 basis point hike, potentially with another 75 basis point hike in September. We're looking at, either way we slice it, probably a full 1.5% of rate hikes between July and September, bringing us up finally to the magical 3%, which is actually deemed to be above neutral. Neutral being roughly about 2.5%. So we're probably going to get above neutral much faster than ever before, and this is what markets are suggesting the Fed do. The Fed just hasn't been doing it. So why do I believe the Fed is finally potentially willing to just do it? Because there's something really important to know about the Federal Reserve. Okay, folks, I can't believe this, but when I said it was 33%, in the process of us just exporting the video, we got an update that the odds of a 100 basis point hike have actually moved up to 50%. But then, as we started updating that, we got another update that now the bond market is pricing this in fast now, folks. The current odds for a 100 basis point hike, a full 1% hike, bringing us from 1.5% to 2.5%. The odds of that 100 basis point hike happening in July 27th, are
67%.
and then we get crashed into by Max, who's got a really fast car. What kind of car do you have there? A Lambo? Both of you got Lambos. Yeah, well, that's how fast inflation is running away, that you kind of need a Lambo or the Fed to have a Lambo to catch up. But folks, look, it's obvious. The Fed and markets are realizing, dude, Fed, stop with the accommodative crap. You were still buying bonds in May. Wake up and hike. The Federal Reserve realizes that there's one thing that they can do very, very quickly, that the COVID pandemic taught us. They can print money very quickly. They can U-turn very quickly. If they need to go soft because inflation falls off a cliff and they need to U-turn on us and start printing money again and start supporting the economy, they can do that overnight. They can do that really, really, really quickly. What they can't do is fight inflation by pussyfooting around. And they realize that. And that's why I think by the July 26th to the 27th meeting, we're finally going to get the Fed that actually puts some pants on. We thought they might do that in the last meeting, but they didn't. So what did we end up getting? Well, not only did we last month have a much higher inflation read than we expected, but this month as well, we get yet another higher inflation read than expected. Folks, the Fed needs to put the pants on, get us to not just 3%, but probably with these inflation reads to 3.5 to as high as 4% as soon as possible. This does mean paying for stocks in the shorter term and paying for real estate, which could create buying opportunities. In my opinion, it does. At some point, though, we do think that those inflation pressures are going to lead the Federal Reserve to U-turn, and we know that they can do so quickly. And this is something that I really think is critical that most of us forget, is that the Fed can U-turn to our benefit fast. They can help us fast. But dealing with inflation takes time, really putting the pants on. Now, ironically, even though the Federal Reserve has totally been missing it with putting the pants on, the markets are still pricing in the fact that, oh, no, we actually think inflation's going to come down. Let's take a look at this chart, and then we're done. Then it's time to go back to vacation, okay? Because every time I go on vacation, bad market data comes out, and I'm sorry. I apologize for it, I swear. But take a look at this, folks, and I don't know why now, but I sound like Patrick Warburton. Okay, so what do we got here? This is the break-even inflation rate for the 5-year. This is the market's expectation of inflation. It's the white line right here. You can see that recently that white line has been plummeting. The orange line is the 10-year break-even rate of inflation. And one of the things that you can do is you could run over here and you can notice that when the break-evens plummet, usually you get CPI, or the blue line, that plummets after. It's really kind of interesting, but take a look at that over here. You could see those break-evens start falling. Inflation drops anywhere between 3 to 5 months afterwards. When the break-evens move up, we tend to see inflation move up 3 to 4 months after that. That's what we're experiencing right now. We had the break-evens for inflation move up over here in February and March. Here you go, break-evens peaked. What happened then? Inflation sits over here. 2 to 3 to 4 months later, we've got inflation now potentially and probably peaking, although the type of inflation we have is really, really broad-based. And this is a danger, because if we have broad-based inflation, what's to say it's actually going to come down? The hope, though, is that it will. And for some reason, the bond market seems to think they're much smarter than us, who are living that day-to-day life of going, wow, prices keep going up as fast as Kevin raises prices on his programs. I'm building your wealth. But hey, you know what? That's because we keep adding more content, so you get a better product every time over time. But this chart, the break-evens are implying that inflation should be plummeting within the next 3 to 4 months, because you could see the break-evens have started to crash within the last 30 days, and that implies that within the next 3 to 4 months, inflation will come down. But between now and then, the Fed needs to act. Put the frickin' pants on, hike the rates already. You can always talk softly and nice to us in the future by you turning back. But put the frickin' pants on, do your damn job, show the markets that you're going to do your job, and get inflation under control. Hopefully the bond market is right, and if they are, you can U-turn quickly. Great. But let's not play the game anymore of, oh no, is the Fed going to do 50 or 75? It's not working. Get it done. And get ready to go shopping for real estate, because I think the longer Treasury yields stay up because inflation keeps going up, real estate's going to be on sale more.